Video 3. This is the fun stuff. Fun tip for me, maybe probably going to be the most difficult section for you to understand anyway. And we're going to be covering 3 major things here. Office and the home deduction. We're going to be covering depreciation and amortization, along with section 179, and car mileage. One of the biggest deductions for small businesses often is the mileage that they drive, okay? I've been at it a long time. Like I said, about 30 years I've been doing this, and I think I've only seen in maybe 2 instances in all that time. Mind you, I specialize in self-employed tax returns. So in all of that time, only twice has actual expenses made more sense than the mileage. And the reason why is the mileage has fluctuated between 50 and 60 cents per mile. Well, that number is rather large. Gas has got to get a lot more expensive, and mileage on your car has got to get a lot worse for that to not be good enough. And the reason why that number is so high is because the Internal Revenue Service prices in depreciation into it. So the cost of the car is sort of worked into that number. I'm going to tell you, take the standard mileage deduction. What does that mean? It means every time you get in your car, keep a log, or better, get your, I don't know where my phone is, get your cell phone and get some sort of mileage tracking application, okay? I think one's called like Miles Bug or something. That was one of the earliest ones. Just find something you're comfortable with. It's easy as hitting a button when you start driving and hitting a button when you get home. That's it. And what that does, and you'll probably enter like the business purpose, because the Internal Revenue Service does require that if you're going to take this deduction, and an ample deduction it is, they do require that you keep a miles log. And that log has to include date, destination, purpose, and miles. So the date you went, where you were going, why you were going there, and how many miles you drove. At the end of the year, you add up all those trips, and you report to your tax accountant the following. I used a 2022 Honda Civic. I put on a total mileage, including my personal use mileage. I put on a total 23,492 miles, 23,492. Of the 23,492, 8,170 of those miles were business. Now, please, don't go to your tax accountant and say, I put on 23,000 miles and 9,000 were business. No, they weren't, okay? The chances are astronomical that both of those numbers would not only wind up round, but round to the 1,000th. Like, I could do the math on that. It's very unlikely. Does it happen? Sure. I've never seen it happen. And that's another thing. When you go to your tax accountant, you are not doing them a favor if you are rounding your numbers. Don't round your numbers, because that's possibly the biggest red flag that the IRS is going to see. As soon as they see round numbers, they're going to know that you estimated your numbers, okay? Now, I've had very, very meticulous clients round. They get the actual number, then they round to the nearest 100. It's a terrible idea. Give your tax accountant the actual numbers. They will be very thankful, and you will be less audited. Always good. Okay, I'm not going to get into actual expenses on your vehicle, but it's not that complicated. It's your lease payment. It's your the amount that you paid when you first bought it, and not your loan payment, please. Please, not your loan payment. And then repairs, maintenance, gasoline, oil changes. You give that to your tax accountant. So I guess I did go through it. But you take whichever's greater, and mileage is almost always greater. The exception here is when it's a work vehicle, like 100% work vehicle, and it's not your work vehicle. It's like it's a car that you provide to your staff. In that case, actual expenses probably will make more sense. Anyway, that's good enough for that. Let's go on to office and the home deduction. Second most complicated, or in the middle, let's say, okay? So office and the home deduction. You're going to want to give your tax accountant 2 things. Well, more than 2, but 2 things to figure out the percentage. The exact square footage of your office, okay? And your office should be a separate, clearly identifiable space, preferably that has a door that shuts on it, okay? So I'm in one of my offices. This is my studio, okay? Then I have my actual office. And both my studio and my office is actually built into a residence, okay? So for me, I do take office in the home, and I do it based, well, as we're required to, based on square footage. So you add up the square footage of your workspace, office space, storage space, okay? That number and your total square footage of your home. I don't usually want to know about your basement, but if you insist on including your basement or it's a finished basement, we can talk about that. But generally, at least in New York, we're talking about the square footage of your home, first and second floors, not a cellar, and the square footage of your office. You divide the small number by the big number, you got your square foot, or you got your percentage business use of your home. Now you give your tax accountant what? Not your mortgage payments. You give him your mortgage interest statement. That is your 1098. That includes your interest paid, your taxes paid, your insurance paid, and anything else having to do with escrow for your requirements, okay? That's an integral document for your tax accountant. Plus, for your regular tax, you're going to need that anyway. Now, what else? The sum total of your electric bills, the sum total of your gas bills, all your utilities separated total for the year. And then we'll use the square footage to figure out the percentage that's deductible. And of course, if you don't have a mortgage, then you've got to come in with your real estate taxes. You've got to come in with your homeowner's insurance, and you've got to come in with any other repairs and maintenance on the property. Okay? Pretty straightforward. And the repairs and maintenance on the property is going to roll into the final part of this video, which is depreciation and amortization. Big words that basically mean, I'll again use the example of this computer. Here's a computer that I'm going to be deducting on my income taxes. This computer has a useful life of more than a year. So being that it has a useful life of more than a year, I'm not going to deduct it necessarily all in 1 year. I can still take the full amount in 1 year, but I have to show the IRS, hey, I'm making an investment in the business. I am buying equipment that has long-term value. This is really important because it shows reinvestment in your business. It shows an expectation of profit, that you are putting money, your hard-earned money, into equipment that should translate into future earnings, profit, and ultimately tax for the IRS. So I'm not saying they love to see a huge number for depreciation, but it does bode well for showing that you are a legitimate business who is truly trying to make a profit. Now, what do you need to do? Each asset you need to give to your tax accountant separately. And that could be if you buy a computer and a printer and a hub and other peripherals, best to give them separate. Now, computer equipment, yes, you can group it all together, but better just to give it separate. They may want to break it apart a little because you may think of this printer, oh, it's just a printer. You just depreciate it like the computer. Well, maybe it's a industrial printer that has a useful life of 7 years, not 5 years, something like that. Let's just consider each asset that has a useful life of more than 1 year and cost, let's say, more than $100, $200. Those are individually listed items. Now, what do you need to individually list? Date of purchase, name of asset, and amount. So when did you buy it? What did you buy? And how much did you pay for it? And in this case, if you are paying sales tax on it, include that. The sales tax is included and is deductible for you. And it's not deductible in some other place. It is deductible as part of the cost of the asset, okay? Every asset class has a different depreciation period. So a computer, generally 5 years, printer, generally 5 years. Other tools and machinery, generally 7 years. A vehicle, well, vehicles we should talk about separately, but just if you bought a vehicle and you're taking actual expenses, or you bought a vehicle and you gave it to one of your staff, then yes, that's a depreciable asset. Let's take this microphone. So this microphone is going to have a depreciation period. The cable, it doesn't cost enough to really depreciate that. That can go in supplies, okay? Remember that supply is not included in part 3. That's not an office supply, and that's also not part of cost of goods sold, but it is a supply. So that would be an example of something that didn't fall into those two categories that we talked about in video 2. So how about a battery pack? That's probably depreciable. I think this was, I don't know, some amount of money that was more than a couple hundred, and that's going to last a fair amount of time. What else we got here? Here is a audio interface. Let's not disconnect this. We need this because it's got the microphone in there. That is an audio interface. It has a useful life of more than a year. So what you really need to do is give your tax accountant a spreadsheet. Column 1, date. Column 2, asset name. What did you buy? Column 3, how much did you pay? And keep your receipts for everything. Keep your receipts. You don't have your receipt, don't write it off, okay? Simple as that. You don't need the headache of not being able to substantiate your deduction if you are audited, and people do get audited, okay? I handle a fair amount of audits each year. They're usually very straightforward, and we win them all, which is great. But the reason why we win them all is because we don't let our clients write off nonsense, okay? So be a good record keeper, keep your receipts, and don't give your receipts to your tax accountant unless they request them. I do not need your giant box of receipts. Thank you, but no thank you, okay? I either trust you because you've already established yourself as trustworthy, or I'm going to suss it out and I will ask you to produce some receipts, okay? Fair enough? Thank you. So depreciation, amortization. What is amortization? Amortization is depreciation, as in you take it over a period of time, of intangibles like business startup costs, scouting. You buy the rights to something. You buy intellectual property from somebody. That is an amortizable item. So amortization, for the sake of your tax accountant, is exactly the same as depreciation. You report to them what you bought, when you bought it, how much you paid for it. I bought the rights to this intellectual property on such and such a date for such and such amount of money. Good enough. Now, if you bought something over a period of time, you can let them know that. But the date is when you put it into service. Really, that's true for everything. Most people, when they buy it, they start using it. But if you bought something and you didn't use it for 4 months, what we really want to know is the date you started using it in business. For most, it's going to be the same date. But if in your case it's not, let them know the date. Let them know the date that you started using it. Fair enough. Okay. Final item, Section 179. You don't need to know a lot about this because your tax accountant should be telling you you should use 179 here. So let's say I write your tax return and boy, you had a good year, but you also bought a lot of equipment. Instead of taking this computer and writing it off over a period of 5 years, I may say, let's take a bunch of it up front. Let's take 100% of it up front. And that is what is Section 179. You can use Section 179 to take depreciable assets, and instead of spreading them out over 5 years, you take them all at once. So you get the benefit all up front. This is the reason when you hear Amazon didn't pay tax, you're like, really? Amazon didn't pay tax and I did? Usually the reason is, other than tax shelters offshore and all that, if it is domestic in the United States and they're not paying tax, probably it's because all of those profits are being reinvested into business equipment. So Section 179 is a huge, huge windfall for big businesses, but can be very helpful for small businesses as well. So make sure you utilize that, but your tax accountant should be able to lead you properly there. Now, I forgot to start with this. Remember, don't believe everything you read unless it's, especially if it's on somebody's hat. But if you read it in the IRS publication, then you definitely should believe it and you definitely should follow it, because no matter what, in every single case that I've had somebody show up my office door, whether they came from a different tax preparer or somehow snuck something past me and got the oh no letter, all they want is to be able to go back and do it right, okay? So don't intentionally do something wrong, please. It's not worth it, okay? And if you do make a mistake, best to remedy it as soon as possible. Fair enough? Good. So once again, thank you for tuning in. That's everything you really need to know, excuse me, for Schedule C for a sole proprietorship or for a sole member LLC or a qualified joint venture. But if you got questions on that, we'll make another video. Thank you very much. And yeah, hope you're doing well. Bye.